The chances of a deeper correction are fading. Interest rates have stopped going up, and the amount of stocks trading higher is starting to accelerate. In last week's analysis, we covered why January 15th would be the turning point for markets if inflation surprised to the downside. And that's exactly what we saw.
We got some really important news. So the CPI came in cold. This is what we were expecting.
CPI was dovish, and actually I think some of the inflation prints the last 2 days have been dovish, including PPI.
Shelter disinflation leading the charge. So that kind of calmed yields down, allowed equities to find their footing.
So it's setting the stage for yields to kind of cool.
Yields are long-term interest rates. As they cool, expectations for earnings growth can rise.
And at a time when sentiment's been negative, I think we should be rallying.
Core CPI minus food and energy came in lower than expected, which reduced the future expectations of inflation. This is a huge macro shift. The bond market can adjust interest rates lower, and the Fed can pull in rate cuts closer. This was a huge positive surprise, and keep in mind, surprises move markets.
The market was bracing for a really hot number. There was a 30% plus chance of a Fed hike. Those sort of extreme views have been quelled.
It's kind of ridiculous to watch. I mean, you had people screaming for emergency rate cuts back in the summer and now saying we don't think we're going to have any cuts from here and the Fed's probably done. Maybe the next move is a hike.
The inflation print over the next 3 months is going to be a lot lower than what we saw November and October. And remember, January to March of last year, it was close to 0.4. So I think inflation is setting up for some good comps.
Okay. We're not going to 8% mortgage rates. The Fed is not considering hiking. The economy is not that great, like relative to last year. It's definitely not better.
There is no chance of a rate hike. This week's retail sales came in weaker than expected, along with jobless claims showing weaker employment. Macro is telling us the economy is strong, but not even close to overheating. And when we put it all together, this week's macro report sent the dollar and interest rates lower, which made financial conditions easier for markets to navigate. Easier financial conditions lead to more risk-taking. But the good news doesn't stop there. We also got some reassurance about the fiscal deficit.
We have a spending problem. For the past 40 or 50 years, federal government revenues have averaged about 17 to 17.5% of GDP. And spending has been slightly over that, leading us to a 3.5% budget deficit.
Now, the expectation of government overspending drives interest rates higher, but the new Treasury Secretary, Scott Bessent, eased the market's fears by simply addressing the problem.
This spending is out of control. We have never seen this before when it is not a recession or not a war.
But wait, the good news doesn't stop there. Oil prices are also starting to cool, which may have or may have nothing to do with peace in the Middle East.
Breaking news on this Sunday morning as a ceasefire deal between Israel and Hamas has now begun after a brief delay.
So now that inflation expectations have cooled and geopolitical uncertainty becomes more certain, the market can regain the bull market trend. The probability of a 10% correction is fading. But if you're struggling to believe the bull market can gain momentum, well, you're not alone.
There is some inflation that can be generated by tariffs, and that's the uncertainty.
But that's what I mean also. It's like tariffs, it's inflating the deficit. It's just reinflation based on some of the expected policies that may cause that.
When we look at the internals of the market, we can see a bullish divergence, which is how investors feel versus what they're actually doing. Although sentiment is exceedingly bearish, positioning remains risk on.
If you look at like some just bread and butter sentiment indicators, you look at like AAII, the spread between bulls and bears had gone from extreme bullishness right after the election to the most extreme pessimism that we've seen from individual investors since fall of 2023 when the market was making a significant bottom. It's been a nice sentiment reset, and I think the near term is going to be pretty constructive for equities.
Despite how investors feel over the next 6 months, they are positioning into equities over bonds, reflected by tighter credit spreads. And of those equities, they are positioning into more cyclical, high growth assets versus the defensive ones. And this means thematic momentum trades like crypto and quantum computing will likely continue to outperform. And we can also observe this by seeing that Bitcoin is back above 100K and the amount of stocks making new 1-month highs is increasing. Inflation expectations are basically turning from concerning to less concerning. And this opens up the probability of more cuts. As a matter of fact, one of the voting members touched on the possibility.
If we continue getting numbers like this, it's reasonable to think that possibly rate cuts could happen in the first half of the year.
The biggest macro driver of markets continues to be where inflation is headed. If it's headed lower, even at a slower pace, markets can go full risk on as interest rates fall. If it's slightly higher, markets can still stay bullish, but in industries that have pricing power and lower valuations. We call this cyclical value. The direction of inflation dictates which assets receive the most inflows. In my view, inflation is much lower by the end of 2025, with some bumps along the way, which opens up the rotation between cyclical growth and cyclical value.
First of all, a lot of last year's inflation was what they call imputed, because it was just statistically catching up to the price changes of the years before, but it's housing and auto insurance were 80% of the inflation over the last 4 years. And the third is labor markets, which we know aren't in an inflationary position. So in order for new policies to generate inflation, they have to be powerful forces that fiscal spending hasn't generated the last 3 years. There isn't necessarily a connection between growing faster and more inflation. So I'd say that it's difficult for me to make the case inflation's getting strong.
The correction is more than likely over with, and the asset class most likely to benefit from the Trump administration is crypto. Just remember, most meme coins are scams, but decentralized finance is coming to a city near you.
The president-elect has gone from skeptic of cryptocurrencies to more of a believer and is now reportedly planning an executive order to name crypto a national imperative or priority.
We've had about $36 billion of inflows already to Bitcoin ETFs in a net sense. Almost none of that is very long-term, long-only money. At the end of September, only 1% was that very long-term pension fund space. So that really hasn't even started yet, and that's where I'm expecting the cash to come from in 2025. Bitcoin and digital assets right now, the total market cap of the whole sector is only $3.8 trillion. So that's roughly the same as Apple, right? So it's very, very small. So think about the tech industry in the late 90s, very small, very volatile. Mm-hmm. And what you need to see now, once Trump takes office on Monday, is for the administration to do some of what the market is hoping for, right? So this week we've come up to 105,000 today on the hope that after Monday we get some regulatory changes. We already know we're getting changes at the SEC, and perhaps we even get some money coming out of the government to build up, strategic reserves, a la what we've seen in other asset classes like gold. The industry has been waiting a long time to have an administration that looks to be supportive, right? So the fact that we now have an administration that at worst is going to be neutral probably means more TradFi involvement, means more of that long-term money getting involved, and really a legitimization of the industry.